love the channel and find it useful in becoming a happy retiree. Subscribe today. Let's see if Tony was kind enough to hold on through the break. Tony from Athens, you still with us?
Yes, I am.
All right, thanks for the hold. And the reason I thought this was a really good question is that this comes up a fair amount, and it's an interesting problem to have because you've been in just as a reminder if you're just joining us here on Money Matters, WSB Radio, Tony is calling with a relatively common financial, it's not a problem because you can easily fix this one, but it's kind of a crossroads, if you will. Now, the problem in that scenario is that you've created all this wealth, and now if you're to sell it, you've got a 20% long-term capital gain tax bill, 23.8% to be exact if you're in the highest bracket. Remember, the capital gain rate changes depending on what your income is. So in this particular case, they would be paying close to 25% in order to sell and diversify. So that makes the decision a little tougher, right? It's like, if I sell, then I'm going to pay 25% right off the top, which is kind of like the stock going down 25%, right? So it's that's a really hard scenario to justify because there's a lot of pain associated with the sale. A, you've made all this money. B, you're 25% right off the top to the government, which just stings, right? Especially when it's that much money. You're like, well, I'm going to pay $250,000 or $500,000 to the government. Like, it hurts, right?
Right.
In your case, Tony, you don't have to worry about that, right? Because it's all within a 401k. And if you've got some sort of, if you have all of this or a company stock or any stock for that matter in a qualified account, 401k or a Roth or an IRA, then it doesn't matter. Right? You can, every day is a new day. It's all underneath the umbrella of the IRA. And if you wanted to, you could make a sale and as long as it stays within that account and you diversify it, there's no tax bill due. There is a thought, and I'll pause for one moment here. There is a rule called the rule of net unrealized appreciation, the NUA rule, that could apply to you when let's say you retire and you're thinking about moving some of this money and rolling it into an IRA. The NUA rule only applies to company stock inside of your 401k plan that you're allowed to, there's a way to keep your basis, pay long-term capital gain as opposed to ordinary income. And that's a whole nother strategy. So I would just caution you before you take any steps here and sell it or diversify it. I want to talk to you more. I want you to look into the NUA rule because it's something you might want to use in the future. So before you diversify, this is a kind of a very special scenario where you have low basis company stock inside the 401k. You don't see a lot of folks that have this anymore where you could take advantage of that. But let's just assume that we're talking about a company that doesn't have a low basis and you're just going to diversify. This is a quick reminder. Right? If I list these companies, what do they all have in common? If I listed out General Motors, and I said, in addition to General Motors, CIT Group, in addition to that, Conseco, in addition to that, Chrysler, in addition to that, MF Global Holdings, in addition to that, Washington Mutual, what do all those companies have in common? All those stocks went to zero because those companies all went bankrupt. Now, if I added in Lehman Brothers and WorldCom, you would immediately have said, oh yeah, they all went out of business. Lehman Brothers, which is the biggest, right? They had $691 billion in assets as a financial company. They went to zero, right? Washington Mutual, the big bank during the financial crisis in 2008, they were over-levered and they went to zero, right? WorldCom, we know that story, $4 billion accounting scandal. They were the world's largest internet network and second largest long-distance phone company in the world. They filed for bankruptcy in 2002, right? You know all of these stories. And it's a far cry to think the company, the healthcare staple type company that you have for anything like that to happen to that company. But what if, right? So you've got to think about and remember that even though you might have a bluest of blue chip type company, you don't have a ton of tax consequences if you wanted to diversify. And if you're getting close to retirement, you've got to really think about that. So if it's me, I would look a couple of things here. I would educate yourself on the NUA rule because that's something you might want to use in the future, number one. Number two, Yes, for the vast majority of the time, the conventional wisdom is to say you don't want to have any more than 10%. If you've got a really high quality blue chip type company like you probably have, and we haven't even talked about the name of the company, I can kind of, I'm getting I think I know what it is. Then you maybe 20% is the most you want. So I think there's a little more leeway beyond that conventional 10% wisdom rule, depending on the kind of company you have. But even what has been an investment staple, even though they're in the industrial space, General Electric, I mean, if you look at GE stock, it is down 75% since to the end of 1999. It never really recovered after 1999. And if you had $1 million in GE back in 99, it would be worth 250 grand today. That's even a company that stays in business, that's still profitable, still doing well, the stock can still get crushed. And I just don't want that to happen to you. So the answer here is you've got a lot of cover because you're in a qualified plan. So you know that you don't have to worry about paying taxes to diversify it. You've got other options. So you mentioned you have a balanced fund. I like, if you're headed into retirement, you're 60, so you're not quite there yet. But if you were 65, I really love the balance of having 30 or 40 or even 50% in the safe side of the equation, which would be probably that balanced fund, Tony, that you have inside the plan, where you have one half of the fund is equities or stocks that probably pay dividends. The other half is bonds that are safe and there to be stable and not go down when the stock market goes down. And that balance, I think, is really, really important to have going into retirement. You may not need a full 50% in bonds, but something like 30 or 40% is a prudent way to approach this. So the answer is yes. I think that at some point you do need to diversify this. I don't think you need to do it overnight, right? I don't think it's an emergency fire drill here because you have such a blue chip type company, but I do want you to think through using some of those other options. Make sure you read about NUA first, the rule of net unrealized appreciation, NUA rule that applies to your very niche situation here. A lot of company stock in a qualified plan with a very low basis. You bought it for a little, it's worth a lot. That's something that you could utilize and trigger in the future. So a lot to think about, but I don't think you need to do it tomorrow. And it's not a fire drill, but think of ways. I do like the idea of you using that balanced fund or a two or three or four different funds within that 401k to reduce your risk, reduce your exposure to not just that one particular company, but to the stock side of the ledger as a whole. Awful lot to think about here on a Sunday morning. But thank you for your call, Tony. Thanks for listening to Money Matters. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.